Have you ever struggled to trade the London session as an ICT trader? If so, this video is for you. Now, just to introduce myself, my name's Ruben. I've been trading futures for roughly about 1.5 to 2 years. And in that time, I've transversed from the New York session to the London and Asian sessions. In today's video, we're going to go through 4 topics. We're going to talk specifically about the London Open session. So anyone from Australia, any country where maybe you can't trade the New York AM session, this video is for you. And we're going to break it down into 4 key sections. The first is going to be trading times, as you can see here. The second, I'm going to give you some reasons why I like to trade the London Open session. And lastly, probably the most important, we're going to go through 2 trading examples and I'll give you guys an actual entry model that you can use. With that being said, guys, let's get straight into the first section. Let's discuss the actual trading times for the London session I'm talking about in this video. So firstly, let's define what a high probability time is in terms of when we can trade the London session. And for today, I'm going to focus on what's called the London Open session, and that's what ICT refers to as the London kill zone. Now, like I've marked out here, this is from 2 a.m. to 5 a.m. New York time. A lot of people ask me, I'm from Australia, but I still set my charts on TradingView to New York time. That's really, really important. So between 2 to 5 o'clock. Now, within this time frame, there is also a silver bullet session, and I'm going to put that on the screen here. That's from 3 a.m. to 4 a.m. And there's also many macros. Again, a macro exists 10 minutes before and 10 minutes after every single hour. We're going to focus on these 2 macros for today, 250 to 310 and 350 to 410. And there's a few reasons for that, but ultimately these macros line up with silver bullet. They're on the start and the end of the silver bullet session. So that way we can combine the London Open session, we can combine macros, and we can combine silver bullet. So we're combining 3 elements of time. So write that down, take a screenshot, but we're looking for trades in this window, but more in particular, these timeframes here. And I'm happy to execute or look for trades 5 before and 5 after each of these macro times that you see listed. Section number 2 here, guys, is why do I personally trade the London session? Now, before we start, I have traded every single session and I've had success in each. I've traded the PM session, the AM session for New York. I've traded the Asian session, the London session. I've also traded in between kill zones. Anything can really work, but these are the main reasons here, right? So being from Australia, London session is the most accessible to me. The Open or the London Open session, 2 a.m. New York time is 6 p.m. Australian time. So for most people who do work, London session occurs after work, so it's much more accessible. Also, it doesn't conflict with sleep because I don't want to trade something where I'm going to lose sleep and then the next day I'm not going to be functioning as well. I want to trade something that works in my lifestyle, works in my sleep patterns. And this is why I personally trade the London session. A lot of people say to me, there's not enough volume or not enough movement in the London session to take advantage of. And I disagree. And I just want to go to the charts here and show you guys what the London Open session looks like in terms of volume and volatility. And I had that mindset too. I had the mindset that you couldn't trade London Open session because there wasn't enough movement. But unfortunately, the hard truth is, if you can't find trades in this section of price moving up or this section of price down, maybe you need to study a little bit more. And there's nothing wrong with that, but you have to be flexible. All the PD arrays still exist. If we just zoom in a little bit, you can see SMT, you can see fair value gaps, you can see order blocks, you can see market structure shifts. It all occurs the same. It's all fractal, but it's just going to occur on a smaller spectrum or smaller scale. So in terms of what you're looking for the London Open session, you're not going to be aiming for 200 handles, 100 handles, 70 handles. You're going to be aiming for between 10 to 30 handles. And before you say maybe that's not for you, I built many profitable models trading the London session, even the Asian session, which sometimes has less volume and volatility. It's all about being flexible and then working what you got. Now, ultimately, the price range here from low to high, that is 93 handles. This is a massive day, a massive range for London session. Ultimately, you're not going to try and take a trade for 100 handles because sometimes the market won't move that much. As you can see here from the other day on Thursday, we moved 93 handles from bottom to top. That's enough. That's more than enough. And the models I'm going to teach you today require you only to take between 10 to 20 handles. So you can accommodate for any range. Because I'll put on the screen here, most of the time the London Open session could be from 300 to maybe 150. So an average of roughly about 70 or so handles for that session. Another reason why I really like trading the London Open session is because a lot of the time we form the low of the day or the low that forms for the next 5, 6, 7 hours. And ultimately you can see that here. So this low was formed roughly about 3 o'clock if you look at the bottom here. And if I show you the next example, the same thing applies, right? we can see that during this example here, we've got a London low that's formed between 2 a.m. and 5 a.m. The rest of the day, we push up. So what I'm going to do today, I'm going to break down 2 or 3 examples going into these charts, into these examples, and then having a look at how you can catch positions to the upside. The framework is going to be very simplistic. I'm going to give you guys a step-by-step approach on what to look for. And if you're not new here, you'll know exactly what I'm going to talk about. It's going to be macros and also inversion fair value gaps. It makes it nice and easy. Keep it simplistic to see success. For me, I personally trade ICT macros, and this is trading example number 1. Now, just for your notes, guys, a macro exists 10 minutes before and 10 minutes after every single hour. And to put simply, here is the entry model. I look for inversion fair value gaps around macro timeframes, and I look to target low resistance liquidity. Now, what is low resistance? This swing high right here, this swing high right here, this swing high right here. All these swing highs, notice how they're not sweeping each other. They're getting lower and lower and lower and lower. That's what I call trend line liquidity, and that is also what's called low resistance liquidity. And what you'll notice a lot of the time with these moves is price will form all these swing highs like this and will aggressively move towards those liquidity points. And this is simply all the entry model is, guys. You're going to study the macro time frames, roughly 5 before and 5 after. You're going to observe to see if you have low resistance liquidity, and then you're going to look a bit closer for the inversion fair value gap. Now, what I want to mark out at the bottom here, you can see from here to here, that is a macro from 250 to 310 and starts at 3 a.m. So if you use this macro, you're capturing the first portion of the silver bullet session. So you're matching time elements here. Now, taking a little bit of a deeper dive into the chart here, guys, we can see the inversion fair value gap, that's in orange. And what you might notice with price action is we trade back into it here, we trade back into it here. We're using that as support. Now, there's so many ways to use the inversion fair value gap. You can enter as price creates it, so right here, or you can enter inside the macro when we trade back into it here, here, or even here outside the macro. It's completely fine. You should forward test all these entry models or patterns and figure out what you like best for your risk to reward and your psychology. Now, what are some other important elements here? Down the bottom here, you've also got a bullish fair value gap, and you can see price actually respects that gap and we move higher. We've also got what's called a change in this state of delivery. 1, 2, 3, 4, 5 down close candles. When we break above these down close candles here, that indicates a change in the state of delivery. It also creates an order block. And if I extend that across in time, you can see our price uses that as some kind of support. So all these things make for a really nice trade. Yes, you're looking for a macro. Yes, you're looking for an inversion. Yes, you're looking for all this low resistance because it should be a quick move. But you need to also look on the 1 minute chart and then narrow down your focus to these little key price signatures. Do we have a change in the state delivery? Do we have an order block? Do we have a previous bullish fair value gap that's been respected? The more you can build onto your narrative, the better it is. And again, this idea and these ideas, they can safely yield 10 to 20 handles. So when you're trading the London session, aim for 10 to 20 handles, aim for at least a 1-to-1 and call it a day. If it runs more, leave a runner, but at least take something off at those points so you can pay yourself as a trader. That is how you switch from New York session to London session. You aim for less, you hold runners if it wants to run, and you look for those quick moves targeting low resistance liquidity around a macro time frame using an inversion. That's as simple as I can put it, guys. This is a model, and this is a model that I use frequently, almost every single day. Now let's have a look here at example number 2, and this is from the 15th of January. So have a look at that if you want to backtest this or collect the data for yourself. Now if you're enjoying this video, guys, be sure to give this video a like. If you're not yet subscribed to the channel. And if you want any videos made on these topics or different topics, feel free to leave me a comment, and more than likely I'll incorporate your idea into a future video. Now just zooming into price here, there's a few things I want to talk about and mark out. You can see I've marked out 2 inversion fair value gaps, and they're labeled with this orange box. Now taking a deeper dive into price action, yes, there's a lot of green candles, yes, there's a lot of red candles, and at the top here, that marks the buy side liquidity that we talked about previously. It's actually relative equal highs. So we've got this swing high here, which I'll label, this swing high here at the top, and then we've also got this swing high here. Relative equal highs, that is going to be our draw, and that's going to be the low resistance liquidity. Keep that in mind. Now, looking at these 2 macros, this one and this one, this is where we're looking to actually take a trade. But the question would be, well, how do I execute? And then I'm going to give you guys a bit of realism, because a lot of people think that macros never fail, and that's not the case. You are going to take losing trades, but are you able to come back? That is the important part. So taking a look at price action here, I'm just going to show you two macros. This one here is from 250 to 310, and this is from 350 to 410. Every single orange box is an inversion fair value gap that we might want to use to actually execute a trade on. Now looking at price here, we've got one gap that's formed right here, and we can extend that out across in time. You can see our price uses that, it spends some time in there. Then we also got another fair value gap that actually exists a little bit later, and it's a little bit smaller, right? So there's another one over here. But notice this, right? Each macro has a unique opportunity to enter a trade. So we can enter longs from here, we can also enter longs from here. And I'm going to talk about how if you take a loss, how I personally would come back from that and mitigate that loss using ICT macros. Now let's just assume for whatever reason, you take a long as soon as we form that gap. You take a long from somewhere like right here, and your stop goes below these bodies. Maybe you're targeting like a 1-to-1 or a 1 to 1.5, and what would probably happen is your target would not be hit, and in reality, you're going to be stopped at break even. So price pulls back down, and guess what? You get stopped out. But does that mean macros do not work? No. Does that mean the model doesn't work? No. What this means is the market is now asking you to be patient, and as a trader, you need to come back and wait for the next price signature. Wait for the next macro. Relative equal highs. Buy side above here that we talked about previously. These are buy side liquidity points that we're going to try and target. Here is the inversion we're going to try and use in the next macro, and we simply enter again. We enter again when we create this inversion. We put our stop below these bodies, and where do we target? At least this buy side, or this buy side level here. And notice how price from the macro pivots, starts to spool towards that buy side liquidity. Now, while you're looking at this and you're saying to me, well, Ruben, this has happened to me before. I've been stopped out in the first trade, or I've been stopped at break even, but I'm fearful to enter the second trade. My recommendation there would be to collect data so you have confidence to re-execute again. And it happens to everyone, it happens to me. This is the realism of trading. On the screen here, you're going to see two trades that I've taken, both long positions, both targeting buy side, but something similar happened to like we see here, except it was just using different macros. So today we're solely focusing on the London session, and I've given you guys a framework on how to actually execute using ICT macros. You're looking for a macro, you're looking for low resistance or relative equal highs, those two forms of liquidity. You're then looking for an inversion, you're entering. You're targeting that low resistance. If you're stopped out or if you get break even, you're waiting for the next macro and you're looking for the same setup to form. If you wait and if you be patient, guys, you're going to get the opportunity to enter. If you're not patient, you won't be rewarded. And with that being said, guys, if you want more information about this, check out my Discord. The link to that is in the description of this video. If you'd like one-on-one coaching or you want access to my premium services where I can talk about macros in a bit more detail, and I go live on Zoom 3 times a week for the London Open session, just check the YouTube description because I've got all the links there to my private one-on-one coaching, mentorship, and premium Discord. With that being said, guys, I hope everyone has had a great week. And until we talk next time, peace out. All the best.